Hey there, Casey from Century 21. We're back this week with our finance update. Ben from Flint Group joins us. Thanks for coming along, Ben, and
Pleasure,
Nicole,
girls.
our investor consultant. We want to give you a quick update of what's happening in that finance space to ensure you're maximising your return on your investment, but also when you're looking to purchase, that you've done the right DD and you know who to speak to get you the best rates, deals, flexibility. Ben, what's happening overall?
So overall, we've got rates that have been where they are for a little while, but there are a number of lenders that think, mainly the big four banks, that the rates are going to come down early next year, Q1. So ahead of time, we've seen a lot of fixed rates that have dropped quite considerably. They're still not worth looking at, in my opinion, because they're still above where the variable rate is, and with the illusion that they're going to go down in the next 3 to 6 months, which is almost confirmed, it wouldn't be a good option. On the variable rate side of things, though, we have started seeing lenders offer in the high fives, which is the first time we've seen that number in front of a loan that's not a fixed loan for
18 months?
Yeah, 18 months or so. So for significant lending, especially if you've got multiple properties, a bit of debt, we can look at packaging that up and getting extra discounts. So it is a good time to, shop around. There are lenders that have started cutting their rates ahead of any sort of RBA decision. Yeah.
And what loan structures do you recommend with investors right now to make sure they're maximising their tax benefits?
Yeah, good question. So always interest-only loans for investment properties. As a general rule, if you've got debt on your primary place of residence and you're still paying that off, interest-only for all investments, to maximise cash flow and not deplete the tax deductibility of the interest associated with the loan. That's the general rule. If you do then have no loan on your current primary place of residence, then it's probably a good opportunity to sit down with a broker, a financial planner, and work out if it's better to pay that loan off or maybe invest that extra money that you'd be indicatively paying off the principal into something else that's more dollar productive.
A second investment. So that's where a lot of people struggle with understanding there is good debt versus bad debt.
Yep.
And good debt is an investment property. So if you've got no loan on your principal place of residence, there's equity within that property that allows you to capitalise to buy that second investment property. So actually having those questions with Ben or our investment team is what we specialise in to help you grow to that next property, to help you become a multi-property portfolio investor.
Yeah, definitely, Casey. And I think that especially for a lot of people that are still working full-time, that are still in that accumulation stage and that have got the benefit of time on their side, buying a high-quality investment property with all the right fundamentals, so it's in a good location where it's going to grow, it's going to attract a good tenant that looks after the property, that pays a good rental return on the property, and then having that structured in a way that's using equity opposed to cash will keep the double benefit of the compound capital growth of the property going up, the rental income going up, but also, the tax deduction that we like at the end of the financial year coming out of the property too.
Yeah. Ben, can you explain the pros and cons with an offset account with investment loans?
Yeah, really good question. So it sort of comes back to what I was saying before with, if we've got investment debt, it's tax deductible debt, and we want to try and keep the debt on that property to offset the income so we can get a tax deduction out of that property. So if we're paying extra on the loan, we are diminishing that future tax deduction, which, depending on the stage of life, can be a good thing, can be a bad thing. If you're still working, you don't want to be paying more tax than you already are. So if you've got that money in offset, that would always be the better option than having it in redraw, because we can't actually, increase an investor loan to try and increase the tax deductibility without doing modifications to the property, renovations, buying an additional property. So it's a very, very sacred thing, investor loans, and making sure that if you don't know where to put the money, put it in offset. But then again, it might be good to talk with a broker in conjunction with a financial planner to work out overall where's that best place, because it could be invested in another property, it could be invested in shares or something that's earning that return, rather than just sort of offsetting interest that is tax deductible.
And that's like long-term strategy, right?
Yep.
Like understanding where you want to be and what the end goal is, and kind of working backwards from that. And I think that's where a lot of our mum and dad investors buy a property, because if you buy an investment property, it's a good future plan, but understanding what that strategy is to end goal to retirement, and really talking early with a financial planner to ensure.
Yep. And I think it's a good point. A financial planner, it can be misunderstood. They sort of sit in a triangle between the accountant, the planner, and the broker, and we're all working as a team on the client side to try and maximise, their future position, and understand, when they're wanting to retire, what they're wanting to acquire, what income they're going to need to retire on, how that's going to be funded, using equity in properties to, increase that asset base, that's leverageable as well. So your asset goes from 500 to $1 million, you've got another 500,000 that you could loan to, invest in shares, invest in another property. There's a lot of options there.
You always say property, not shares.
It's important to be diversified.
Wrapping it up, if you were first home buyer in the market today, what is the best advice you can give a first home buyer to get into the market? Obviously from the pre-approval process, but how do you start to buy your first investment or first property in general?
The earlier you sit down with a broker, the better. I think that's probably the biggest thing. That I deal with a lot of clients that, are almost a little hesitant to sit down because they don't want to waste my time because they're 6, 12, 9 months away. But the earlier we have that conversation, the better, because what I find with a lot of first home buyers, especially young professionals, is that they actually can borrow more than they think. And we can actually introduce some first home buyer schemes, guarantor loan options. There's quite a lot of things we can do there to help guide them into their purchase. And the earlier we sit down, the earlier that they can start thinking about the numbers associated, the monthly repayments, and getting comfortable with that, to try and avoid, we found a property, we need to move super urgently, rush, and sometimes it happens too quickly and the buyers won't feel ready, and then they actually pull out. And then they might actually not find another perfect property for, a good period of time. So never underestimate sitting down early, having a plan. It might be a savings goal, it might be on your next pay review you can achieve the price point you want, or it could simply be that you're in a better position than you actually think.
Perfect. Thanks for popping in today, Ben, and having these conversations. If our landlords, buyers, tenants that are looking to buy an investment property, how do they reach out to you?
So Ben Robinson, Flint Group. If you search me online, you can find me. Ben Robinson at flintgroup.au is the best email for me.
Perfect.
Awesome. Thanks, Ben. Thanks, Casey.
Pleasure, girls.